Now, if you're Canadian and you own a rental property right here in Canada, you're going to want to watch this video right to the end. Hi, my name is Rav. I'm a chartered professional accountant right here in Ontario, Canada. And my goal with this channel is really to educate the Canadian population on taxes so that they can make informed decisions. So in today's video, I'll be going through how rental income in Canada is taxed. So let's get into it. First, we need to define what rental income is. In a nutshell, rental income is income earned through renting out property. Now, there are different types of rental income, such as residential real estate, commercial real estate, and short-term rentals. In this video, we'll focus on residential real estate income. So now let's get into the reporting of rental income. In Canada, you must report all rental income you've received on your annual tax return. So let's say you collect about $30,000 during the year from your tenants. All $30,000 has to be reported on your annual income tax return and taxes paid on that. If you own your residential property that you're renting out personally in your personal name and not in a corporation, on your annual tax return, you'll have to report the rental income on a form that's called the T776, which is the Statement of Rental Income. So let's get into a little bit of the detail about the T776, the Statement of Rental Income. This form is really used to report all your income and expenses that you incurred for your rental properties during the year. Essentially, this form helps the Canada Revenue Agency understand how your rental income was formed during the year. Now, there are some key sections of the T776. Number one is the identification of the property. This will provide details such as the address of the property and whether it's residential or commercial real estate. Part two is income, and here you'll put all the rental income that you've received during the year. For part three, which is expenses, this is where you list all your deductible expenses during the year, such as insurance, property tax, mortgage interest, and repairs and maintenance. Part four is the capital cost allowance. And this essentially calculates the CCA that you want to claim on the property. And later on in the video, we'll go through what CCA is. One important fact that you want to keep in mind is to keep receipts and all documentation to support your T776 Statement of Rental Income. Now, there are normal operating costs that are associated with the rental property that are deductible, such as your maintenance, your repairs, your mortgage interest, your insurance, and property taxes. But you also have non-deductible expenses. For instance, when you first purchased your rental property, the purchase price is not immediately deductible as an expense. Instead, you have to capitalize it as an asset and depreciate it over time using that CCA or capital cost allowance method. Another non-deductible expense is your major renovations that you do to the property. Let's say you put in a new kitchen and it increases the value of the property. Some of that would be considered furniture and equipment. You'd have to basically capitalize it, depreciate it over time. Anything that essentially enhances the value of the property, makes the property value go up, is generally not considered a repairs or deductible expense. Now moving on to the capital cost allowance, or CCA. So what is CCA? CCA, or the capital cost allowance, is essentially a depreciation expense that the CRA allows you to take, and this essentially acts as a benefit as it decreases your taxable income, which in turn reduces your overall tax bill. So let's go through an example. For a building or a rental property, that would be Class 1, which allows for a CCA rate of 4% on a declining balance method on the undepreciated amount of the total property. For example, let's say your rental income is $50,000 and you claim $12,000 in CCA or depreciation, then your taxable income reduces to $38,000. This reduction in your taxable income can result in a lower tax rate, meaning you pay less tax on your rental income. Now, one very important consideration when claiming CCA is to consider the effects when you actually end up selling that property. When you sell the property, all the CCA that you've taken over the years and you've enjoyed a tax deduction and a reduced taxable income for all those years, unfortunately, when you sell the property, you're going to have to put all that CCA back into income in the year that you've sold the property. Now, generally, I know I've talked about CCA a lot here. However, it is advisable not to take CCA on rental properties. However, each situation is different, so make sure you contact a tax professional. Now for some brief tax planning strategies. If you have multiple properties or a significant rental operation, you should consider incorporating to enjoy some of the tax benefits that are associated with that. So that was the summary of how rental income is taxed right here in Canada. If you need a good accountant, my information is in the description below. Also, if you found this video helpful, please give it a thumbs up, like, and subscribe. If you have any questions that you'd like to share, please drop it in the comments below. Thank you. I'll see you in the next video.